You know that feeling when you're watching a market that just can't seem to lose? It goes up, and suddenly everyone feels like a financial genius. It's an amazing, intoxicating feeling. But what happens when that feeling is actually a trap? Well, today, we're diving deep into that fascinating, predictable, and frankly terrifying life cycle of financial bubbles. And we're going to follow it all the way to its most destructive end, hyperinflation.
All right, so here's the game plan. We're going to start with that seductive pull of a rising market. Then we'll break down the classic anatomy of a bubble. Yep, there's a pattern. We'll look at what really lights the fuse, and then trace the whole thing from boom to the inevitable bust and right into the abyss of hyperinflation. And finally, we're going to ask the big question. Why on earth do we keep falling for this every single time?
I mean, there's really nothing quite like it, is there? The buzz of a market hitting new highs every day. It's this energy that just lifts everyone's mood. It dominates the headlines, and it makes all of us feel just a little bit smarter, a little more ahead of the curve.
John Kenneth Galbraith absolutely nailed it with this one. When prices are soaring, it is so easy to believe you've cracked the code. I mean, your portfolio's looking great, your friends are all getting rich, the news is just a constant stream of optimism. But this feeling, this collective genius, this is the exact fertile ground where the seeds of danger get sown.
And this, right here, this is the million-dollar question, isn't it? We all think we are. We tell ourselves, I can ride this wave. I'll get out. I'll step aside right before it crashes. But as we're about to see, the data says our confidence might just be tragically misplaced.
So, how does all that excitement and euphoria build into something so dangerous? Well, it turns out financial bubbles aren't just these random, chaotic events. Nope. They follow a remarkably consistent pattern, almost like a roadmap from pure mania right into a crash. Economists Charles Kindleberger and Hyman Minsky laid this all out in a classic 5-stage model. It all starts with what they call a displacement, some shiny new thing, like the internet or AI that gets the smart money really excited. Then comes the boom. This is where a really compelling story grabs hold and cheap money just pours fuel on the fire. That builds to euphoria, where everyone wants in, from hedge fund managers to your cousin, convinced it's a sure thing. But then the crisis hits. Insiders start quietly cashing out. And finally, revulsion, where sheer panic takes over and prices just collapse, falling way, way below any rational value.
And this just brilliantly shows that pattern in action. You look back at the 1920s, and it was all about radio stocks like RCA. The story? This new technology is going to change everything. Then you fast forward to the 1990s, and it is the exact same story. Just replace radio with internet and RCA with Yahoo. The assets are different, sure, but the human psychology and, get this, the actual shape of the chart are just eerily identical.
And it is not just about tech. We see the exact same bubble shape in commodities, like gold back in the 70s, and in entire national stock markets like Japan's Nikkei in the 80s. The details change, but that parabolic rise and the absolutely devastating fall, that stays the same.
So you have to ask, what is powering these massive run-ups? The spark might be some cool new tech, but the fuel, the high-octane gasoline for the fire, well, that often comes from the very institutions that are supposed to keep the economy stable, central banks.
There's this fantastic analogy for this from the Darwin Awards. You have these two bank robbers in Belgium, right? They decide to use dynamite to open an ATM. Good plan. But they used so much dynamite that they didn't just blow up the ATM. They blew up the entire bank, and themselves along with it. This is kind of like central bank policy. They're trying to give the economy a little nudge, a little boost, but their tools, like printing money, can be incredibly imprecise, and they often end up using way too much dynamite, creating this massive explosion they never intended.
And all that surplus explosive force, it actually has a technical name, excess liquidity, or Marshallian K. It's all the money that central banks create that doesn't actually go into building factories or hiring people. Instead, it just floods into financial markets, chasing stocks, bonds, and real estate higher and higher. This is the dry powder that really ignites the bubble.
But, as we all know, the euphoria can't last forever. Every party has a last call. The music eventually has to stop. So let's take a look at how these bubbles finally, inevitably burst.
The turn is often pretty subtle at first. The insiders, the folks who really know their industries, they start to sell. Then the momentum shifts. The speculators realize the game is up. But here's the real problem. When the selling really gets going, the buyers just vanish. Nobody wants to be the one to catch a falling knife. It's just like that Roadrunner cartoon moment when Wile E. Coyote runs off a cliff and hangs in the air for a second before he realizes there's no ground beneath him. That's the crash. It's a liquidity crisis where suddenly everyone is a seller and absolutely no one is a buyer.
For some economies, believe it or not, a market crash is only the beginning of the pain. In the absolute worst-case scenarios, the crisis of confidence doesn't just hit stocks or houses, it hits the currency itself. And this, my friends, is the path to hyperinflation, the ultimate economic nightmare.
So hyperinflation isn't just, high prices. It's a complete, total collapse of faith in the money itself. The classic definition is an inflation rate of more than 50% per month. Now think about that. At that rate, something that costs $100 on January 1st would cost nearly $13,000 by the end of the year.
The most infamous example, of course, is Germany's Weimar Republic. In November of 1923, the monthly inflation rate hit over 29,000%. Just try to wrap your head around that. Prices were doubling every 3 to 4 days. People would get their paycheck and literally run to the store to spend it before the cash in their hands became worthless.
But the all-time world record? That belongs to Hungary, right after World War II. The monthly rate hit 41.9 quadrillion %. Prices were doubling every 15 hours. They printed a banknote for 100 quintillion pengo. It's just mind-boggling.
And look, this isn't just some ancient history lesson from a black and white textbook. As recently as 2008, Zimbabwe's monthly inflation hit nearly 80 billion %. The government was printing $100 trillion bills that couldn't even buy you a loaf of bread. Eventually, they just had to abandon the currency altogether.
Now, what's so fascinating and so chilling about this slide is how it translates these insane, astronomical numbers into a real human feeling. This is from the diary of an Austrian widow back in 1920, right as inflation was starting to spiral. Her investments were making her a millionaire on paper, but it didn't feel right. She felt a secret uneasiness, this deep-down sense that none of this wealth was real. It's just a powerful reminder that behind all the data are real people, watching their entire world fall apart.
And the aftermath is always devastation. An entire generation sees their life savings just wiped out. The economy gets completely twisted out of shape, society itself is torn apart, and ultimately people just give up on the local currency. They resort to barter or try to get their hands on more stable foreign money, like the US dollar.
Which brings us to our final and maybe our most important question. If these patterns are so clear, if the consequences are this horrific, why do we keep doing this to ourselves?
This quote from Nobel Prize winner Vernon Smith really gets to the heart of it. He actually ran these experiments where he created asset bubbles in a lab environment. And even when the people in the experiment knew they were in a bubble, every single one of them believed they were smart enough to get out just in time. And you know what happened? Every single time, they were completely surprised by how fast it all unraveled.
And that right there, that's the ultimate paradox of all of this. We know the pattern. We've seen it play out time and time again throughout history. And yet the only real surprise is that we are always surprised when it happens again. It seems we are just hardwired to chase those rising prices, to believe that this time is different, and to wildly overestimate our own ability to outsmart the herd. And that human element, well, that may be the one fundamental that never, ever changes.